free Tesla stock? Prove you deserve it, and it's all yours. You can get a free Tesla stock from a leading European stockbroker. If you win this challenge, Tesla is one of the most exciting, innovative companies in the world, and you can own a small bit of it for free just by winning a 5-day trading challenge. All you have to do is successfully trade a simulated demo account. No deposit, no commitment required. Join millions of other investors worldwide by owning one of Tesla's stocks. Do you think you can make it? Click right here, right now, and join the competition.
Are you concerned about the current fluctuations in the world's economy? Here are 3 pieces of advice from eToro users on how to trade safely.
When you are looking at an asset on a chart, you are seeing the action of the price between buyers and sellers. That's why we call it price action. As traders, we're trying to trade with the flow of the larger buyers or sellers in that market. These buyers and sellers not only make the market move, but make it move in cycles. Phases are small predictable patterns in market price, driven by cycles of buying and selling. And now, you're going to learn how they work. It would be easy to think that when the price of a market goes up, it does so in a straight line, but this is not normally the case. If you look at any chart, you will notice that price tends to move in a very particular way. It almost looks like it's breathing. In this example, we can see that the price is trending up. But as it does, you can see the undulating movement described by our breathing analogy. Price goes up, back down for a little while, then resumes its upward motion before going backwards again. In this reverse example, we can see the market is trending downwards. Again, you can see the breathing motion quite clearly. It goes down for a while, then back up a bit, then resumes its downward motion before going backwards again. As traders, we call these cycles or phases, and understanding them will help you identify entry points for your trades in a trending market. In this uptrend example, let's simplify the chart so we can more easily see what is happening. It is now clear how the price is moving in these cycles or phases. As the price moves upwards or in the same direction as the trend, it is said to be in phase 1. At the point the price starts moving back down again, or against the trend, we consider that we have entered phase 2. The cycle then repeats. You will also notice that in general, phase 1 tends to be longer than phase 2. The ideal time to buy in this pattern would be at the point that phase 2 ends and phase 1 is beginning. Or in other words, at the point at which this bounce occurs. It would not be a good time to buy at the point at which phase 1 is ending and phase 2 is beginning. With a downtrend, it may help to imagine you are holding up a mirror to the uptrend example. Phase 1 still occurs when it is in line with the direction of the trend, which in this case is downwards. Phase 2 begins when the price starts moving back up or against the downward trend. The ideal time to sell in this example is the same, the point at which phase 2 ends and phase 1 is beginning. Again, it would not be a good time to sell at the point where phase 1 is ending and phase 2 is beginning. As traders, it's generally advisable to trade in the direction of the dominant trend. For the same reason, it would be inadvisable to swim against a tide. Whilst technically you could choose to sell at the point phase 1 turns into phase 2 in an upward trend, you would essentially be moving in the opposite direction of the upwards momentum, and doing so may leave you at a disadvantage. So as we've seen, it is essential to understand the inherent behavior of the markets and make sure that we are trading with the trend. As we also noted earlier, the market generally repeats itself on many levels. So we tend to see smaller phases during shorter time frames, but we also see larger phases during longer time frames. Understanding how the market is moving at different time frames will give you the best grasp of the market's overall direction. This will ensure that you are able to judge the potential strength of a trading opportunity. Let's have a look on SmartCharts. Pick a currency pair and take some time to really examine the price carefully and try to spot the phases. If you're using SmartCharts on a desktop or laptop, in the charts area you can use this grid tool to split the chart area into 4, which will allow you to look at multiple charts at once. You can also link the charts by colour linking them together. Do this by clicking on the circle at the top left of any chart. You can now change each chart to a different time frame. You could, for example, have one on 5 minutes, one on 1 hour, one on 4 hours, and the last on 1 day. If you change the currency pair on this one colour linked chart, it will change all the windows at once. This method will allow you to do multiple time frame analysis on a number of currency pairs, one after the other, extremely quickly and efficiently. Just as a final note, although you can colour link charts in the mobile version of this web app, due to size limitations, you won't be able to see multiple charts at once on smaller screens, such as the one on your phone. Hi guys, today I want to introduce you to my 5-3-1 strategy. That is the secret sauce to the most successful currency traders. Understanding intimately 5 currency pairs. They're the majors, they're the most liquid, they're the ones that are the cheapest with the tightest spread to trade. 3 strategies that can help you make money and monetize the market in all market conditions. And most importantly, what does the 1 stand for? It stands for trading at the same time every day. Now listen, I've been a currency trader for 24 years. I own trading floors and training centers all over the world. What I don't know about this game probably isn't worth knowing, but here's the exciting and the good news. I'm putting on a brand new webinar where I'm going to teach you one of these strategies from start to finish. If you're somebody who's hitting 2020 with the outcome of making money, with the outcome of keeping the risk low, with the outcome of taking you somewhere different than where you've been from last year to this year, then this is going to be an amazing webinar for you to jump on and for you to jump on right now, because I'm going to be teaching you start to finish one of the most explosive trading strategies in the currency markets today. It's going to show you when currencies are turning round. Now, turning round points are critical because when a market turns around and then makes a rejection to the downside, meaning that the selling dries up and explosive buying comes in, it creates 2 very important signals. I'm going to be exposing those 2 very important signals to you, but more importantly, I'm going to show you how you can use some simple software. When I say simple software, accessible to anybody and everybody, you can start using almost immediately to start monetizing this market, keeping that risk low, and then turning yourself into a lifestyle trader. A lifestyle trader is somebody who doesn't need to sit in front of a screen for hours on end every day, less than 2 hours a day to produce an income that you could live off. Now that is a big, bold claim, and it's one that I want you to investigate fully. So join me on this webinar that I'm about to host by clicking on the link either below this video or around this video. Jump on in, and if you're one of the lucky subscribers to this webinar, I'm going to give you a free coaching session where you can understand if trading is right for you, if you're the right mindset, and give you a brand new income generation worksheet so you can understand how much money you could possibly make in what period of time. If that interests you, then jump yourself into that webinar, and I look forward to seeing you there. As we've seen, when trading, it's our job to decide whether we buy, sell, or simply wait until the markets become less choppy or volatile. Having a good understanding of the condition of the markets before placing trades is as important as looking at the condition of the sea before going sailing. You may have heard markets being described as going upwards, downwards, or sideways. In this module, we're going to have a look at exactly how markets move, and more importantly, how we can try to predict when a market is likely to move in a particular direction. There are three basic market conditions: trending, reversal, and ranging. You could use these terms to roughly describe any market you're likely to come across. Let's first examine a trending market, whilst keeping in mind a market can be trending up or down. We identify a trending market by examining the highs and lows of the turning points of the phases. When a market is trending upwards, the highs in each phase will continue to reach new highs, and the low or bouncing point in every phase will also continue to reach new highs. In other words, the market is creating higher highs and higher lows. We can see a clear pattern of higher highs and higher lows in this example, and so this market is said to be trending upwards during this period. In a market that is trending downwards, you would be looking for a succession of lower highs and lower lows to confirm a downward trend. Each subsequent high in the price is at a lower point than the previous one, and each subsequent low in the price is also at a lower point than the previous one. During an uptrend, traders aim to buy low and sell high, and vice versa on a downtrend. There is a famous saying amongst traders: "The trend is your friend until the bend at the end." Whilst trends afford us plenty of opportunities whilst they last, they eventually run out of steam and change direction. And so we endeavour to make some good trades until that happens. This brings us neatly to the next market condition, which is a reversal or change of trend. A change of trend is when one trend ends and another starts. It is seen as a turning point in the market. There may be clues that a reversal in trend is about to happen. In an uptrend, we usually see a succession of higher highs and higher lows. If a lower high or lower low suddenly forms, it could signal that a change of trend is about to occur. In a downtrend, if we suddenly had a higher high or higher low form, this could signify the same thing. By anticipating a turning point in the market, a trader could catch the next trend early and maximize their trading opportunities. The last market condition is what we call a ranging market. Ranging markets are said to be traveling sideways, and as such are also sometimes referred to as sideways markets. They're caused by indecision in the marketplace. If a trend ends and price starts moving sideways, the trend may still suddenly resume or even reverse completely. Ranging markets still afford traders opportunities. Traders can buy at the lows of the range and sell at the highs of the range, using the mean or middle price as their target. We call this reversion to mean trading. During prolonged ranging markets, buying or selling pressure may build up, and this could create a powerful price movement once price breaks out of the range. Traders may also find opportunity when this happens by entering the market once the price has broken out of the range and a new trend has been confirmed. This is called breakout trading. Whilst past performance is no guarantee of future results, in terms of cyclical price action, you may find that history can often repeat itself. You will also discover as you become a trader that different currencies have different personalities. So spending time understanding what a particular currency does during different market conditions will become an essential judgment tool. You will have a much better chance of assessing the condition that the market is in and what it may do next.
My Way, the new fragrance, Giorgio Armani.
This module is for myself and every other trader out there, probably the single most important. A conversation about risk may not be the most exciting you're going to have, and it's unlikely to win you friends at parties. But when you consider that a good trader is effectively just someone who manages risk well, the importance should become clear. In other modules, we're going to teach you how to understand price, how to find potential opportunities in the market, and how to try and take best advantage of them. But it's incredibly important to remember that this end goal of trading is not to take great risk by trying to make a quick profit, but instead to protect your capital and aim to be a long-term trader. There are potential opportunities in the currency market every single day. If you want to be in this for the long term, you have to train yourself to see the market as something that is always giving you opportunities, despite your natural tendency to overly focus on that one opportunity that you missed. There is no lack of potential opportunities when it comes to the currency markets. We just need to be sure that we take good care of our capital so that we can reduce our risk and continue to consider opportunities over the long term. I cannot stress enough that this module should be one of the absolute cornerstones of your future trading behavior. Watch it today, watch it tomorrow, memorize it. Explain it to your significant other during a romantic moment. Well, maybe don't do that last one, but do keep on coming back to make sure that you understand it implicitly and therefore are building your strategy for the long term. If you think bigger risk means bigger rewards, you may find yourself at a considerable disadvantage when it comes to your trading performance. Ask yourself what your number one priority when trading is. Most new traders will give you some variation of the same answer, which is that they are there to make big money. To the victor, the spoils. But if you ask the same question to a professional trader, someone who has a decent amount of trading experience, they may give you a very different answer. Their primary objective when they trade is to manage their risk. They have learned that keeping their trading capital safe is the first step towards trading success. In fact, a professional trader may only risk up to 2% of their total account value on any one trade. In order to manage the risk, traders use a simple maths equation so that they can enter their trade size into their software correctly. Let's say you have a $10,000 account and you are looking to enter a trade at 1.2250 with your stop loss at 1.2200 and your take profit at 1.2300. This is the risk management calculation we will use. Since we are willing to risk 2% of our account on this trade, first you need to work out 2% of $10,000. The answer is $200. Next, you need to work out the number of pips at risk, which is the number of pips between the buy entry price and the stop loss level. In this case, you will see there are 50 pips at risk between these two levels. Now we have enough information to calculate our trade size, which in this case is $4 per pip. This trade size value is what you need to manually enter into most software platforms if you wish to correctly risk manage your trade. Once this trade begins, for every pip the price moves in your favor, you will make $4. Conversely, for every pip the price moves against you, you will lose $4. This makes the total loss $200 if the price eventually hits your stop loss level, but equally, you would stand to gain $200 if the price hits the take profit level. If this sounds complex, know that whilst many software platforms require you to manually perform these mathematics on every trade you wish to execute, SmartCharts not only automatically calculates the risk for you, but will also place your buy entry, stop loss, and take profit levels, and all with a simple click of a button. As you can see, none of this is particularly complicated. One of the markers of good advice is that it's usually straightforward and easy to follow. Don't run across a road. Don't take expired medicine. Don't pull a lion's tail. Whatever. The good advice here is to make sure that you have good risk management rules and that you stick to them, regardless of emotion. What you've just learned is one of the biggest differences between people who manage risk effectively and those who gamble. Just to be clear, trading without risk management or a strategy is gambling. A gambler is someone who will ask, how much can I win? Where a good trader will ask, how much could I win and how much could I lose? Be sure to congratulate yourself, because if you have understood and accepted what I've just told you, you have just taken a very important step to understanding what it means to be a trader. In 1995, a man called MacArthur Wheeler robbed 2 banks in America in the middle of the day with absolutely no attempt to hide his face with a mask. As you can probably imagine, he was pretty easy to catch. But when the police brought him in, MacArthur was stunned. He stated that he had put lemon juice on his face and should therefore have been invisible to the security cameras. He was working on the misunderstanding that as invisible ink shares some of the same properties as lemon juice should have effectively worked to hide his face.
Are you concerned about the current fluctuations in the world's economy? Here are 3 pieces of advice from eToro users.
Hi guys, welcome back to the Trading Den. My name is Greg Secker, your host here, and today we're launching a brand new initiative. We are starting to do weekly market forecasts and market context positioning. What is that all about? Well, it's a new concept that we're bringing here to the Trading Den, where I give you a market forecast every week, show you really what's happening, what to focus your energy, your attention, and most importantly, your trading strategy and focus upon. And that is something we're going to continue doing alongside the quests and alongside the educational pieces that we do on a weekly basis. So we're going to start that right here, right now. What we're going to do right now is get right into how the market is set up right now. I'm going to show you how I set my day up. It's kind of important that you have the opportunity to see how I set the game up each week. Now, of course, market conditions change every week, and for that very reason, I want to spend my time now on a weekly basis setting you up on a Monday or a Tuesday, depending on which day I get on, but hopefully the earliest part of the week, to really show you how the week's going to play out, show you how my mind is thinking, and show you where I'm finding opportunities and how I'm setting myself up for the game. So we're going to jump straight into SmartCharts, our favorite tool of choice, of course, and show you how I'm setting the game up. Now, I want you to know off the bat, my favorite currency pairs are the euro dollar, our sterling, and dollar yen. I also love the Aussie dollar and I love the Kiwi dollar. You're going to see why I love the Aussie dollar and the Kiwi dollar, because I've already got trades on those this morning. In fact, some of those trades have already completed and hit me a profit. So I'm going to show you what I'm looking at, why I'm looking at it. Let's dive straight in. And I've set my screen up slightly differently today, and that's for a very good reason. Today we are the 9th of June, and that means that markets have changed somewhat. We've seen big swings in the markets. I'm going to start with the euro. I'm going to move through sterling. I'm going to look at the dollar yen, and then I'm going to look at my favorites, the Aussie dollar and the Kiwi dollar, and then I'm going to wrap the session up here today by looking at the indices and that early morning market breakout. Now, for those of you that have seen previous videos I've done, I have shown you the breakfast breakout. Time is right now 8:45 in the morning. So that hour period from 8 in the morning when the UK stock market opens to 9, that hour range creates us what we call a breakfast breakout range. You're going to see if that range is created this morning and gives us the opportunity to place a breakfast breakout trade, because market conditions right now are between trending, highly volatile, and breakout. Let me show you what I mean. Let's start right now with the euro. And I want you to look at how I've set my screen up in SmartCharts. You'll notice on the left-hand side, top left-hand panel, I've got a fib screen on the daily. And the reason I'm doing that is I want to draw your attention to the levels. Then I'm looking at a strategy screen, which of course is the 180 phase changer. Then I'm looking at an alligator, which is telling me if it's trending or if it's ranging market conditions. And then of course, lastly, on the bottom left is my pivot screen. Now, why have I got my screen set up like that? Well, let's go through it and show you exactly how I set the game up in the current market condition we're in. The current market condition we're in, just to be really clear, is we've had a great trending run, but things are starting to change right now. Markets are topping out. We're having some retracements coming in, and we're seeing some ranging period. You only have to look at the euro dollar on this 4-hour chart to see, whilst we've had these nice ranges up here on the daily, we can see now, of course, if you look at the bottom right-hand screen here, that alligator, if you haven't seen that alligator indicator strategy I released last week, please go and have a look at that. In fact, if you click on this icon here, you'll get straight into that video. The alligator strategy really tells you if markets are ranging or if markets are trending. We know that it's easier to make money in trending markets than it is ranging markets. So what do we do? What do we do when markets are ranging? We've bet our buck on trading the markets. We don't have a day job. We want to make money in the markets without putting ourselves in a position where we're taking on too much risk. But how do we set ourselves up so we can take advantage of trending market conditions, but being aware that markets may well have topped out, such as the euro dollar? There may be further upside. We know we've broken those big fib levels, but what happens if that market starts to range? How do we set ourselves up so there is opportunity for us without taking on extra risk to kind of falsely create an opportunity that doesn't really exist? How do we set ourselves up when we're in this difference between a nice trend and then a flattening and a ranging market? 2 weeks ago, very easy to trade. We had markets breaking out, alligator opening up, trends starting, very easy to pick longs, picking the bottom, buying those dips, simple stop, grabbing profits. You can do that all the way along for the last 2 weeks. Now, markets are starting to get into that phase 2 mode where they're starting to retrace and pull back and flatten out. How do we set ourselves up? So let's take a look first of all at the euro dollar. I want to draw your attention to the fact, in fact, if I just move my, if I look at this major swing that we had up and down, by the way, if you're not aware, this is the daily chart. This is the fib level, and you'll notice there seems to be an interaction around the 71% level, the 78% level on the Fibonacci, which means it's broken through the 61% level when the euro dollar bounced and then started moving back up. So this was that big retracement, and then we're trying to get back to that 100% retracement. We did break through the 60%, but you can see if the daily is looking like it's flat, you can certainly see on the 1 hour and the 4 hour, you're talking about a real ranging market. So what does that mean? Well, it means that in this current market condition, we must be aware, first of all, what is the upside, what is the downside potential? Breaking the 61%, we would expect that market eventually to get back to that 100% retracement level. So effectively, we are expecting further upside. But if we are day trading this market, we've got to take much more of a session-based view. So our view really is that we expect the market to continue up and to continue further, hitting that 100% level. As we've learned in previous sessions, if the markets break that 61% level, we'd expect it over time on the daily to get back to that 100% level. But really, what is happening? Well, if we now look from a session-based perspective on the euro dollar, we can see it hit that pivot line. For those of you that don't know much about pivots, if you click here, you'll see the pivot kind of strategy training session I did previously. But effectively, if the markets break through that pivot, and we're looking to take short positions from a session basis. Now, if we jump back to this 180 phase changer, we can see lots of longs being called, but you'll see there's a real disparity between the longs being called on the euro dollar and what's happening from a pivot type picture. Then, of course, we look at the alligator, jaws are closed. What do? Answer, euro dollar, absolutely nothing is the actual answer, what we want to be looking at here. We know the market's flat here. There isn't strong trading opportunity. We'd expect to see similar things across cable. So we're going to have a look at cable. But where we sit right now is you've got conflicting signals really between euro dollar on the daily, on the 4 hour, and then of course what we're seeing on that 5-minute picture on the pivot line, which basically means that market is going like this, tick tock, tick tock. If you go in there and try and play the tick-tock game, play the ranging game, you're going to get burned. So don't do that. That's my first analysis. Always start with euro dollar first. Why? It is the most traded currency pair of all time. The euro dollar has the most volume. It's the European community against the US markets. Of course, it's the most voluminous traded game in the world. So very important to notice that we are in a flat market on the euro. I'm going to switch now to sterling so you can see what we're seeing here on the sterling analysis. You should see a relatively similar picture. Again, if I bring up the fib chart on the daily, and it's a great way to start, guys. We start looking just
what is the swings? How is the game setting itself up? And what you should really notice here is that as we had the high here and then we had the low, in fact, if I bring these numbers across, you can see that the high here was, of course, you know, that 132 level. The low here was that 114 level. Serious swings in currency movement there. You'll notice that as that technical picture has broken through the 61% level, we would expect this now to go all the way up to that 100% level. We'd expect that to happen. We are seeing a flat